And we're live. Welcome to the Real Estate Development Land to Legacy podcast,
Real estate development.
the ultimate resource for aspiring real estate developers and enthusiasts. I'm Eugene Gershman, bringing over 20 years of industry experience to guide you through the dynamic world of real estate development. In each episode, we dive deep into the journeys of industry leaders, uncovering their wisdom, successes, and the lessons learned from their challenges. Whether you're just starting out or looking to elevate your expertise, this podcast is designed to provide you with actionable insights and inspiration. Stay tuned as we are welcoming our new guest today, who has been helping miserable landlords regain their freedom by investing passively since 2006. Mr. Tom Dunkel, welcome.
Hey, Eugene, thanks so much for having me today. Looking forward to our conversation.
Excellent. Thanks for being here, Tom. So tell me, since 2006, how do you find your miserable landlords? How did that happen?
Well, there's a lot of them out there, Eugene. When people get into real estate, a lot of people like me, that's how I started out. I got into it myself. I picked up some rental properties. I was doing my own fix and flips in the residential world. And man, before I knew it, I was just miserable. But of course, now I owned all these properties and I had a team and I had all this stuff going on. And so it was really challenging to kind of unwind that and kind of rebuild and refocus. But that's what I help people do is because I hear it all the time. It wasn't just me. There's other people out there who, they're looking for financial freedom, or they're looking to get out of their W-2 job, or they're looking for some better way to make their way through their financial life. And so a lot of people turn to real estate, which is awesome. Real estate is a fantastic vehicle to build wealth, build cash flow, et cetera. But a lot of people get into it and they think they need to be active and own the properties and manage the properties and find the deals and raise the money and do all this stuff. And I'm here to tell you that you don't have to do all that. The best way to go about it is to find some key professionals, some key team members that can handle different things for you so that you can really go out and enjoy your life, enjoy the wealth that you've built, enjoy the cash flow streams that you've built. So as an example, Eugene, I have an investor of ours we've worked with for a couple of years now. He's about my age, mid-50s. He has some kids that are like, college age. And he inherited some properties from his father, and then he kind of added on to it. And so next thing he knew, he had a bunch of rental properties, some commercial properties, this, that, and he's managing it all himself. And he came to us, he's like, man, I'm just tired of doing this. My kids don't want to take it over. It's just too much. So what he decided to do is as he's selling off these properties, he's taking his proceeds and he's investing them with us at Belrose Storage Group, because we can generate passively about the same level of cash on cash returns that he was generating on his own actively. But he was putting in a lot of work, a lot of sweat, a lot of aggravation, all those kinds of things. So we're helping him transition from active to passive, as we've been helping many people over the years. But I think of him as being such a great example of so many people out there who might have gotten into real estate with these great aspirations, and now they're like, oh, geez, what did I get myself into?
Excellent. Yeah, that's an interesting story. We actually experienced a lot of similar transactions where we would meet new people. They have a piece of land or a tear down home that they've inherited from their parents, and they're looking what to do with it. And we're looking at improving those properties and building something new. So it doesn't sound like you're developing anything, right? You're acquiring existing properties.
That's right. Yeah. I've over my career been acquiring existing properties, maybe adding on to them or that sort of thing. But no, haven't. My experience is not like yours in the development, the design, and the building aspect of things.
Right. And so how do you know what property to invest into? What are you looking for?
Sure. Yeah. We turn over a lot of rocks, kiss a lot of frogs, whatever other metaphor you want to throw in there, especially these days, because sellers are still hanging on to the valuations that they had on their properties, a couple of years ago, and now, of course, with rates up way higher, it's kind of put a damper on real estate values, and so we're not able to pay as much. But I feel like we're starting to have that convergence again, where buyers and sellers are a little more closely aligned, and our pipeline is actually very, very active now. We happen to be in the self-storage space, which is highly fragmented, which means there's lots of mom and pops. A lot of people out there think, oh, well, self-storage is dominated by public storage or Extra Space or CubeSmart or some of these other big REITs. But the fact is, those companies only command about 35% of the overall self-storage market. The other 65% are onesie twosie mom and pop owners that they don't really run it like a business. It's kind of like a side thing for them. And so they're not really using the latest technologies, using the latest software platforms, running marketing programs to fill up their units and keep themselves competitive. So what they do is they keep their rates artificially low, which keeps their occupancy high, which is what they want, but it's not the best key performance indicator if you're running a self-storage facility to be full, right? I have a friend of mine used to be in the hotel business, and similar to the airline industry, if your plane is full, your hotel is full, you're not charging enough. So you need to be pushing those rates so that you can optimize the revenue, not necessarily optimize the occupancy.
Right. Interesting. So if I'm developing a self-storage facility, what type of an indicator? So I'm, building my model, and I noticed Excel is one of your favorite tools. I love Excel. I'm an Excel nerd. What are the parameters that I need to solve for to make sure that when this building is built, I can exit at the most optimal rate?
Yeah, that's a great question. I guess there's lots of things. I guess like other asset classes, multifamily or short-term rentals or what have you, in self-storage, we look for markets that are solid as far as population growth. We don't want it growing too fast, and we certainly don't want it declining. So we kind of look for that Goldilocks scenario in the middle there. If it's growing too fast, that's going to attract the big REITs, the big real estate investment trusts that basically have really low cost of capital. They've got a lot of money. They've got all the resources, so they can go and build stuff like crazy and suck up all the demand in that market. And we also don't want it to be like a declining market, because obviously there goes our demand for storage units. So we look for that Goldilocks scenario in between. And similarly, on the demographic side of things, we look for solid income. So similar kind of thing. We're looking for that Goldilocks, nice middle ground there. We don't want the area to be too affluent, because those people are going to be buying big houses that have plenty of storage and they won't need us. And then on the other end, we don't want incomes to be too low, because then we're going to run into poverty issues and collection issues and management issues and those types of things. So we look for that solid middle ground. On the actual building side of things, Eugene, I would say you want to look at what the exit value per square foot is for a facility. And then from there, you want to kind of back into where your all-in cost to build number should be, so that you can have some cushion in there and be able to create some value for yourself, and then leave some meat on the bone for whoever's going to come in and acquire that. So, for example, as I mentioned, we haven't done any big developments, but we have done some expansions. So I'm going to try to remember the numbers off the top of my head, but we're doing an expansion at a facility down in Georgia, and our all-in cost to build it out was, again, I'm going off the top of my head, but I want to say it was about $100 and maybe $120, maybe $130 per square foot. But we know the exit value of facilities in that market is closer to like $300 per square foot. So we know we're building out this extra space at our facility, and we're creating that arbitrage opportunity where we're building for, call it $130 a foot, and we're selling for $300 a foot. So we like to see that.
Gotcha. That's really cool. And one thing you mentioned earlier is that in today's market, a lot of owners still have unrealistic expectations of their value. How do you determine that disconnect between what the actual value is versus what their perceived value is?
Sure. Well, I mean, we're a very disciplined acquirer. It kind of comes from my background. I used to do mergers and acquisitions in the corporate world and in the aerospace industry before I got into real estate. And I was taught by some very smart private equity guys long ago that you always want to be very diligent with your numbers. You want to kind of under promise on your projections and over deliver, so you can create great returns for your investors. And so we say no a lot to sellers who are asking for too much. And one thing we've done recently, Eugene, that's getting a lot of traction is talking to sellers about seller financing. So if they've created enough equity in their property, we can sometimes, it doesn't always work, but we can usually, in the situation that works, we'll be able to put a down payment in place that will pay off the rest of what they owe, if anything, and then they can finance the rest of the purchase by basically becoming the bank. And so instead of having to run the facility and deal with all the management stuff, they just become the bank and they get their mortgage payment every month, and then off we go. And we take it over and we run it, and we put in our value add strategies and create a lot of value. Then when we sell the property, we pay him back, and then we make a profit as well if all goes well. So we're trying to find those kind of opportunities, and we've been successful many times, and it's really a great win-win. I mean, really, it's a win-win all the way around. It's a win for our investors because a lot of times those notes that are financed by the seller are interest only. So that makes our cash flow higher at the facility, so we can pay our investors more of a dividend. And then, of course, we're getting fees and splits and stuff. So it's a win for us. And it's a win for the seller because they're getting out from managing this thing. They're just getting interest payments like the bank would get. And they're able to spread their tax burden out over a number of years because they're not just getting a big slug of cash right up front that they'd have to pay a lot of taxes on.
Right. Interesting. So it's similar in a way to selling the property to you and then investing back into it passively, right?
Yes.
Because they're still attached to the property in one way or another.
That's right.
And they're still continue to generate income from it.
That's right.
What about interest rates in owner financed deal? Are you paying higher interest than you would to a bank?
Believe it or not, we're actually paying less. And because that's how we position it with the sellers. Hey, we can go get a bank loan. And let's say in today's environment, let's just say it might be 7%. When we tell them, hey, we can go get a loan at 7% with the bank and all that. But you know what, if you're okay offering us 6%, then we can finance the property through you. You're going to make some more cash flow. You'll actually make more money over time. And so that's kind of how that discussion goes with the seller.
Right. Interesting. And they make more money over time because of the appreciation, because they can get a portion of that future.
Well, they're getting these interest-only payments over time. So then they get all their principal back in the future. So they can make hundreds of thousands of dollars more than if they just sold it outright right up front.
Right. Interesting. Mm-hmm. That's pretty cool.
Yeah.
So how do you finance deals? When you're looking to acquire property, real estate typically requires a lot of equity. How do you find that equity? How do you put together that financing package?
Sure. Yeah. So as I mentioned a second ago, we on the debt side, we do look to get seller financing in place. If that's not a possibility, then we can get a bank loan. Bank loans, we're getting best execution from either small local banks or credit unions. And, they're starting to loosen up a little bit. For the last maybe 18 months, 2 years, banks have been pretty tight in this inflationary environment we've been in. So they've been only lending about maybe 65% loan to value. We did one deal, it was only like 53% loan to value. And so but that's starting to loosen up. We're actually getting ready to do a deal now that's going to be 70%. We might even be able to push that to 75% loan to value. The interest rate's higher now, but so we always are shopping around, looking for the best execution on the debt side. And then on the equity side, so if the bank puts up call it 70%. Then the other 30% comes from our network of loyal investors that we've gotten to know over the years at Belrose Storage Group. We do what's called a syndication. So these investors come in passively, and for their, call it $100,000 investment, they own a piece of the LLC that owns the property. And because they're an owner, they're going to get distributions and interest, I guess what we call preferred dividend payments. They're not interest payments because they're not a lender. And then they'll get when we sell the property, they'll get their capital back. And then there's a profit split. And so they can generate, solid double-digit returns passively, right? Because we're doing all the work. We're finding the deal, vetting the deal, running the Excel models, doing all the demographic studies and the market studies, finding the lender. We're putting all that together, and then we're bringing in our professional management team with our software and technology and our experience on the operations side, so we can implement our value add strategies and create great returns for our investors. So it's really, frankly, it's pretty satisfying. It's pretty fulfilling to be able to offer those kinds of opportunities to our investors out there, because everyone's looking for a good, safe way to build wealth, build cash flow, and real estate, especially self-storage, is a great way to do that.
Great. So for somebody getting started that doesn't have a network of investors, what would you recommend to go to start collecting these this database of potential investors?
Sure. Yeah. I mean, it takes a lot of work. We made the conscious decision here at Belrose Storage Group about, I want to say like 2.5 years ago, we restructured the company so that raising capital or building those investor relationships and educating them and nurturing them and loving on them, so that when a deal does come along, they're ready, they know what they're getting into, and they pull the trigger and they invest. We made that a full-time job, and that's my job. So because before that, me and my partners, we were kind of overlapping on things, and we were kind of just looking at our warm relationships, and which is super important, and you need those warm relationships as people who already know, like, and trust you to help get you started, so you can get a little bit of a track record going. But really, Eugene, what's helped us grow our business is what we call cold outreach. So this is reaching out to people that we don't know, we don't have a relationship with, and getting them involved with our company so that they do get nurtured, they do get educated, so that when a deal comes along, they know what they're getting into. And so we do that by using social media. We're out a lot on LinkedIn, especially, but also Facebook, Instagram, YouTube, so that we're just getting our messages out. So, like, for example, this podcast is a great way for me to kind of get the Belrose story out there and let potential investors know that we're here, and we have this great track record, we have this great team, we have this great experience, so we can be trusted to be a steward for people's investment dollars. And so I've been doing the podcast tour for a while now, and getting my name out there, doing some speaking engagements and that sort of thing. So it happens kind of organically, Eugene. So it definitely takes some time. But like the events, they help to kind of give you a little bit of a pop, and but it takes some time for sure. So it's something you can't just jump into tomorrow and then expect to raise $5 million next week. It's something you really have to work towards and get around the right people too.
Right. Yeah, no, that's great information. We have these conversations with our partners a lot, and they ask us, well, if I just wanted to do it on my own, how do I get it done? We're happy to help, but this is great advice. Just keep doing it, and keep marketing yourself.
Yeah, and believe it or not, Eugene, there are just like there's mastermind groups for self-storage or for developing or for multifamily. There's actually a mastermind group for people who raise capital for real estate deals. It's called Raise Masters. And if anyone wants more information on Raise Masters, they can certainly reach out to me. I've been a member for a couple of years, and it's a great community of people who are all very similar. We're all out there, trying to raise capital from investors for real estate deals. And there's all different kinds of techniques and this and that. And of course, the market's changing, so we all share ideas about, hey, what's working now, because what worked a year ago might not work now, and how are things evolving. And so we can certainly an organization like that can definitely help investor or capital raisers find investors for their deals.
Yep, exactly. And for full disclosure, that's how Tom and I met through Raise Masters. Great community, great resources. So Tom, tell me, what would you consider was your greatest professional accomplishment?
Oh, wow. That's a great question. I mean, I was in corporate world for about 12 years. I've been in my entrepreneurial career about 18 years. So I got about 30 years, Eugene. But I think in my corporate career, I think my biggest accomplishment was just being able to be around some amazing people in the aerospace industry. And I was working with Harvard MBAs and Wharton MBAs and ex-fighter pilots and actually some astronauts. So it was pretty cool. So that gave me a great foundation. And then now in my entrepreneurial career, I think my greatest accomplishment has been really building a team that is, kind of taking Belrose Storage Group to the next level with the mentorship of myself and my partners. So it's really rewarding and fulfilling for me to kind of see these younger people come along and learn and grow and become leaders themselves. I think that's really cool because they can help kind of the next generation of investors. They can help their families and their kids and all that kind of thing. So it's really fulfilling.
Excellent. So I couldn't help but notice you started real estate investing in 2006, and I'm old enough to have lived through the 2008 and 2009.
Mm-hmm.
How was that for you?
It was rough, man. It was rough.
It sounds like you got in at the very peak.
I still got the battle scars here from that time period. But yeah, so when I left corporate America in 2006, I was gung-ho to build my real estate empire. And then sure enough, the world had some different plans for me as we entered the Great Recession, and the real estate market started to crash. And it was really, really hard to find money if you could find it at all. And so deals were just crashing left and right under my feet. And so I had just burned through just a bunch of my personal money. And then I'm sitting there in 2009, 2010, like, geez, what just happened? Here I am, I'm a pretty well-educated guy. I had a great, corporate career, and I just got my butt whooped really good for a few years. And, I've got a wife and young kids at home. I had to figure out, what the heck I was going to do. But, I stuck with it. I grinded it out. I got around the right people, like I've mentioned now a couple times, and, been able to build a few successful businesses. And, so it's been great. But finding the right people is super important. The other thing I think is finding a niche to get into. So, we've been in the distressed mortgage niche for 14 years, my partner Joe and I, and then now we're in the self-storage niche. And even within self-storage, there's niches that we're going down into. So I think you want to find those niche areas where you can, find less competition, and that attracts investors too, because they can see, like, if we're finding in these niches, these big supply and demand imbalances, that makes for a good investment environment. And then, of course, just continually getting educated, joining the mastermind groups, going to the conferences, reading the materials, and, reading the blogs, listening to the podcasts, those kinds of things are all super helpful as well.
Right. So if you could go back in time, would you have still started real estate business in 2006, or would you have waited? Or if you would have still pursued that path, what would you have done differently?
Yeah, wow, that's such a tough question because, as scary as it was to kind of leave the corporate nest and go out on my own, like, it was scary, but it also felt very natural to me. So I know, Eugene, I'm either certifiably insane or I am actually an entrepreneur, because I think we just kind of are wired differently and we think differently.
I think most business people are.
Yeah, for sure. But yeah, if I had to go back, I would probably, I sound like a broken record, but I probably would have gotten around better people. I think I would have survived the Great Recession better if I was around some higher quality people. But at the time, I figured, hey, I can put this team together and we'll be fine. But I probably should have been a little more diligent about who I was pulling onto my team for sure. But I thought I could do it all myself back then, kind of like I mentioned earlier. You need professionals to help in different areas. I thought I could do it all myself. I thought I could hire the people and train the people and do the business and get the deals done and do the financing. And that was a bad approach. I should have done a better job of bringing in higher quality people to help in those key areas of the business.
Excellent. I think if there was one lesson that we could all learn from Tom, is that we need good professional people to surround ourselves with.
Yeah, definitely.
And vet them out.
Definitely.
Excellent.
Who Not How. It's a great book.
Right.
I wish it had come out 20 years ago instead of a few years ago.
I know. Well, unfortunately, too many of us listen to advice, never follow it, and then make mistakes, and then end up learning from our mistakes.
That's right. 100%. Yep.
Right.
Totally.
All right. Well, we're coming up on our time. Anything else, Tom, that you wanted to mention about yourself, your business? How do we find you?
Yeah, sure, Eugene. Hey, this has been great. Thanks so much for having me. I would like to direct the listeners out there, if you're an investor and you're looking to get started in alternative investments and maybe you're just not sure how, we have a great resource on our website at bellrosestoragegroup.com. It's called the Safe Investing Checklist. And basically, it's a methodology that's evolved over the years from the mistakes that I've made as an investor, but also the successes. And SAFE is an acronym, just real quick. SAFE. Of course, investing isn't safe, but if you follow these steps, you might avoid some problems. So S stands for sponsor. You really need to get to know your sponsor. I see too many investors skip this very important step and go right to the deal. So you really want to get to know your sponsor first. A is for asset. So that's the asset that you're actually investing in. So with us, you'd be investing in membership interests in an LLC that owns a self-storage facility. And then, the checklist gives you all kinds of questions to ask about the asset. F is for financials, gives you a bunch of questions to ask about the financials of the deal. What are the projections? Has the sponsor hit those projections before? What are the tax implications? Those kinds of things. And then finally, E is for exit. How do you get out of this thing? You can't go to schwab.com and click and sell your position in a Bellrose Self-Storage Group deal. It just doesn't work that way in storage or multifamily or whatever. So you just need to, as an investor, you need to know going in that your money is going to be tied up for a period of time. And you also need to understand what needs to happen for you to get your money back and for you to for the sponsor to hit those returns for you. So go to our website, pull down the Safe Investing Checklist, and hopefully you can make some good investments out there and build a great financial future for yourself and your family.
And of course, we'll have the link in the podcast description that you could click on and get to the website. Tom, thank you very much. There are so many different facets of real estate investing, and stay with us come back for new episodes. We'll have more guests and we'll talk more about real estate investing. Thanks again, Tom.
Thank you, Eugene.
Tom Dunkel, he's the name. Turn your woes into fame. Investing in storage, true, giving freedom back to you. Passive ways he knows so well. His success stories tell. Building futures bright and free. With Tom, it's easy to see.